Welcome back to the Long-Term Investor. Today, I'm welcoming back my friend, Ashby Daniels. Ashby, thanks so much for joining me here on the show.
Love being here with you, Peter.
You and I get the opportunity to talk frequently, maybe not as frequently as I would like, but enough where I know that when we get on the phone, we could be talking about anything. And I mentioned this in the intro, but this is sort of a different format that we're trying out, where I'm hoping that if you're watching us on Cheddar, if you're watching us on YouTube, or if you're listening to us in the traditional podcast form, that maybe this is like you're with the mute button on and the camera off in our Zoom meeting, listening to us chat about a number of things. In case people don't know who you are, Ashby, maybe just give us a little background of how you got to where you are today and what the type of work you're doing today is.
Sure. So I started as a financial advisor at the ripe old age of 25 years old. This was back in 2008. So for those doing the math, I'm 42. And I was a financial advisor for 16 years, actually exited my practice in late 2024. So I have nothing to sell here, which is great. No, but I like I said, was an advisor for 16 years, switched firms in 2008. I started writing a lot, and which actually led to where I am today, which is now I ended up writing basically content for financial advisors, or at least help in that regard with a lot of advisors. So that's what I love doing. And then I basically am in the process of writing a couple of books, and
couple of books.
I have, yes, more than one. Yeah, you don't even know that yet, but yes.
Wow. I mean, I'm just trying to finish one book. You're writing a couple of books. Very impressive. And normally this would be the point in time where I would point people to your business, but there's a giant wait list. And like you said, you have nothing to sell. There's no room even on the wait list at this point. So if you go to the longterminvestor.com, all you're going to do is find notes from our conversation. I'll link to your socials because Ashby's got good stuff to say. And you will want to know when these multiple books are coming out. Before we get into the books, because I do want to ask you about that, one thing that frequently comes up in our conversations is a gentleman named Nick Murray. And I don't know if you actually model yourself after him, but a lot of the work that you do reminds me of him. And Nick, for me, is somebody who acted as like a messaging coach on so many of the things that are important for us advisors to be able to communicate towards our clients. Maybe just give me a second. How is my assessment of Nick, in terms of how you think about him, and how would you view Nick in his role in your life and in the role of other people's lives?
Mr. Murray is unequivocally the most impactful person in my life and my views of how I look at the markets and investing. There's nobody that's had a bigger impact on my life professionally than Mr. Murray. I've never met the man, but I think he's, what they would call the GOAT in terms of writing about the markets and helping people make sense of what's happening. So complete and utter admiration is what I would say for Mr. Murray.
I don't want to be too awkward on camera as I look back at the books, and I buy most things on Kindle, but if somebody gifts me a book, I'll put it up on the bookshelf. Or if I really like it on Kindle, then I go ahead and buy the hard copy because I want to be able to gift it to somebody. And I have, I think, 3 Nick Murray books back there.
I have every book Nick Murray ever wrote is right there.
Yeah, and I mean, it's really good stuff. And it's not that it's complicated. In fact, it's the opposite. He's often simplifying things down to first principle levels and kind of readjusting some of our corrupted thinking, for lack of a better word, our corrupted reasoning, or the noise that, dampening the noise that corrupts our thinking and into something that's pretty simple and actionable and rational. It's what makes me excited that you are writing a book, because your writing has done this for so long. I'm a big fan of your work. I guess since you're writing multiple books, tell me about the multiple books. Last time you were on the show, actually, sorry, and this is part of the casual nature of what we have planned today. Last time you were on the show, we were kind of workshopping ideas of your book where you were challenging conventional wisdom. And again, I'll link to that episode in the show notes at thelongterminvestor.com. But tell us what you're working on and some of the concepts and inspiration behind it.
I'm impressed you remember that, but that is actually the book. So there was a whole lot of career turbulence, if you will, in a good way, not turbulence in a bad way.
Definitely good career turbulence, yeah.
That from our last conversation to this conversation kind of took me away from writing that book. I had basically laid it out, but I didn't actually get to the physical writing of it. And so now I'm about halfway through, but my book is going to be quite a bit different than a traditional book. the very more difficult books that you like to publish. So my hope and intent for the book is to write a book on investing that is, I would say, is say under 100 pages. Like, what is 98% of what you need to know? What can I learn everything I need to know about investing in, say, 1 or 2 hours? And that's really what that book and all of my future books, I hope, will fall in line with that idea. Because I think a lot of times we get so wrapped up in the minutia or the very specific minute details of whether it's investing or otherwise, financial planning generally. And so my goal is just to simplify these topics, simplify these ideas in a way that somebody can actually take it and then do something with it immediately, as opposed to, okay, well, now I have a great overview and now I need to put it into practice. So my goal is to kind of bridge the gap, if you will. So if I have, in the world of investing, I have tens of thousands of hours of experience, but in other areas, maybe it's I take 1,000 hours of learning and condense it down into 1 hour. That's kind of my intent.
Well, you're a voracious reader, and so I have no doubt that you will have a lot to draw from. And I like that concept. One of my most gifted books of all time is a book that's co-authored by Burton Malkiel and Charlie Ellis. And it's called The Elements of Investing, and it's under 100 pages. And it's just those real core, simple principles. And one of the things I've always enjoyed about it is, even though I spend almost all day of every day of my work life thinking about investment issues, or, I mean, there's some things that steer out of the investment realm, but generally speaking, investment issues. But even when you go back and read the basics, it can be enlightening to somebody who is more than a novice investor. And so I think it'll be really exciting when you have those out. I mean, is challenging conventional wisdom still the core focus of book number 1?
Absolutely. I can't think of anything else I would be doing. I mean, if you think about it, most wisdom is the challenge of conventional wisdom. If conventional wisdom is what is widely accepted or paid attention to in the news. I mean, how often do we hear that in the news that we need to be paying attention to, profit margin contractions or what happens with the Fed or whatever? And yet Charlie Munger will say that the great money is not in the buying or the selling, but in the waiting. And so I think it was Munger. I attribute most wisdom to Munger. So whether he said it or not, I don't know. It's a good default,
sure.
But the point is just still the same, which is, the money's not in the buying or the selling, but in the waiting. And so it's like we put all this emphasis on the here and now and what's happening, and it must be so important. But in the grand scheme of things, it is time that makes people wealthy. Not anything else. Not the day to day, but years and years.
Yeah, I'm with you. Time. As long as you don't interrupt compound interest, like you get out of its way, let it do its thing, time's your best friend. I think the problem is everybody keeps interrupting compound interest with their actions, with their behaviors based on what they hear. And it's so interesting. I feel like teeing up a concept like that, because it's so simple, must be difficult because there's a lot of angles. I'm mentioning this as I think through writing my own book. So I'll have the perfect portfolio come out next year. I really wanted the title to be Your Perfect Portfolio, but somebody is publishing with that in January. So I went to The Perfect Portfolio, but I don't think there is such a thing as one single perfect portfolio. And as a result, I'll admit I'm sort of struggling with the introduction. I loved the introduction of Making Money Simple. It's a personal story. This one is also a personal story, but it just feels a little more forced. Maybe you can tease us a little and we can test if you're really writing this book right now. Like, what are you doing for the introduction to introduce those ideas?
So the introduction for my book is somewhat interesting, which is, we're going to go off the rails here. I guess this is the benefit of talking with friends. It actually is about a story where I went to Dave & Buster's. Full disclosure, this is the only time I've ever been to Dave & Buster's. I've never went before this, and I've never been since. But I had one of the most legendary nights of my life in Dave & Buster's, and I'm just going to tell the story. I'm going to take over your podcast
right
here
after this commercial break from Dave & Buster's.
Exactly. So I had a college buddy in town to come to. I lived in Pittsburgh. We were Virginia Tech football game versus Pittsburgh. I'm a Tech grad, and so we didn't have anything to do one night. So we went to Dave & Buster's. And while we were there, we bought what was effectively way too much in terms of access to games, not knowing any better. We didn't know how long we'd be there. We didn't know anything. But we were playing this. We ended up making our way to this football game. And I will Yeah, I don't know if you remember, the football game that you have these little holes and you throw the ball through the holes.
Sure. Yeah.
And I will say, just candidly, I'm a pretty good athlete. I think I can throw a football as well as most people. And I was sitting there, throwing the football through the holes, yet not doing very well. And this guy comes up, he kind of saddles up next to my buddy and I. And this buddy is a college buddy. So we've known each other for 20 years at this point. And this guy saddles up next to us. Let me give you a view of what this guy looks like. He's got khaki pants on that are slightly too short, a button-down Oxford. It looks like he could have gotten it out of his glove box, and glasses. And I'm not going to lie, I judged the book by its cover. And he's just standing there awkwardly for a couple of minutes. And next thing you know, after my buddy and I played the game quite a few times, again, unsuccessfully in the grand scheme of things, he says to us, "Do you guys want me to show you how to beat this game?" And we're like, I'm like, "Yeah, sure. Show me how to throw a football." And next thing you know, this guy, he steps up and he starts shuffle passing them through. Now, if you know what a shuffle pass is, it's, you kind of underhand it through the holes. Well, within like 45 seconds, I don't know how long the round is. Let's say it's a minute and a half. Within like 45 seconds, he's reached the new all-time high, and he just stops. And the machine is just spitting tickets out. Like, you can't even believe how many tickets are coming out of this thing. And he says, "Do you want me to show you how to do it again?" And we're like, "Absolutely. Please show us how to do this again." So he immediately, the machine starts back up. He starts shuffle passing through, and he beats the high score again in like another 45 seconds, and he stops. And we're like, "Why do you keep stopping?" He says, "Because every time I set a new all-time high, I get all these tickets. And so if I just keep barely setting another all-time high, I'll get more tickets." And we're like, "Okay, that's interesting." And so then came one of the great questions I've ever been asked. He says, "Do you guys want to learn how to beat a lot of other games?" And we're like, "Absolutely. Like, let's go." And so right after he shows us how to beat this football game, he says, "All right, here's the deal." After we said yes, he says, you pay for the games, we'll split the tickets 50-50. We're like, done. We couldn't have cared less about the tickets. Like, the tickets were not a thing. Yeah. We could not have cared less.
It's all junk anyways, right? Yeah.
And so anyway, so this guy takes us from one game to another game to another game, and he just shows us how to beat the games. Well, the reason that this is the opening story of my book and how it applies to investing is, I, just like most investors, try to beat the game through brute force, through picking the best funds, through doing the most research, through picking the best stocks, through timing the market, through all these things. Just like I was sitting there throwing a football like I'm throwing it to, Jefferson and, 40 yards down the field. You don't have to do it that way. It's these very simple, if you know how to beat the game, that's the critical factor. Is not how hard do you work, it's you have to know how to beat the games. And so, like, once this guy showed us how to beat the games, it was incredibly easy to beat the games. And so investing works the same exact way. And to put a cap on this story, we ended up getting, like thousands and thousands of tickets was our share. And my buddy and I ended up giving all these tickets to literally a handicapped child that was rolling around Dave and Buster's in his wheelchair. And it looked like it was the best part of his life when we handed him literally these thousands and thousands of tickets. But it was so much more meaningful to us because it was just a legendary night, and we made this kid's day like he's never been made before. It was a great night.
That is a killer story. My kids are obsessed with Dave and Buster's, and I travel a lot for work. And so if I'm about to be gone for a while, or if I'm coming back after having been there for a while, like, give the wife a break, take the kids to Dave and Buster's. We are only recently at hey guys, we're just going to play the games and not buy stuff with the tickets, because it is all junk kind of when you keep going. However, I keep saving the cards, so I think we're racking up a scary number of tickets. All that said, I mean, I love the introduction. you make me feel even worse about the introduction I'm working on. It makes me like, man, I really do need to have a better connection. But it resonates. I mean, you think about, okay, it's not even about the highest score. Like investing, it's not about the highest returns. You just have to do good enough and do something that you can do over and over and over again. Let time do its thing. Pretty compelling. If you're going to have such a short book, are you organizing it into just challenging one conventional wisdom in short essay style as opposed to long form chapters? And if so, like, what are some of the things that you are most excited to have written about or be writing about?
I hope that they flow from one to the next. But if I'm honest, there are a lot of just short essays about major tripping points that I think that people have. And if we want to tie it back to the story, so Jeremy Siegel, who you probably know, I know you've interviewed him, opens his book, Stocks for the Long Run, with a few words. The few words are, everybody ought to be rich. Now, there's history behind that opening title, but I think it's an amazing truth that I think gets massively glossed over because everybody is trying to use that brute force. So just as an example of what I mean, and what I think that, I mean, it couldn't be a better starting point for Mr. Siegel's book because his whole book is the value of stocks for the long run. But this is the factoid that I come back to over and over and over again. The market, as defined in my case in this moment as the S&P 500, opened in 1960 at 60. That's a very easy way to remember. It opened 1960 at 60. Today we're at what, 6,800? So, you know, if you'd have invested $10,000 in the S&P in 1960, you'd have over $1 million today. Pretty easy math. That alone is incredible. But then when you say, okay, well, that doesn't include dividends because obviously the price return is just the price. But if you include dividends, 10,000 would have become 6.8 million. And so what do you have to do? What had to have been done in order to turn 10,000 to 6.8 million? And the answer is not much. You had to buy it in 1960 and you had to hold it all the way until now. Incredibly simple. That doesn't make it easy, but it is incredibly simple. And I think that's the part that I think so many people miss is just how simple it is because we want to make it complicated. Morgan Housel talked about how you would never assume that a regular everyday investor could have better results than a Harvard doctor in doing a Harvard-trained doctor in doing a heart transplant. But in the world of investing, we can outperform 98% of our peers simply by buying the index and holding the index. And so it's mind-bogglingly simple, but it's so hard to do.
You know, I appreciate that greatly. And, you know, the S&P 500, there's actually a gentleman who I've been working with since I've been at Plancorp like just a little over 10 years. And I've been involved with this family for nearly the whole time. They were a client of the firm before I was there. Very successful executive. They've had a globally diversified portfolio. It's been almost all stocks, maybe something you and I can talk about at some point. But, you know, he's in his 80s now, and he's looking back the last 20 years at the S&P 500 beat everything. And he's disappointed. And he's honestly a little angry. And it's, yes, you know, we talk about the market and we learn so much about the market. And as a result, we have to represent the S&P 500 as the market. And look, U.S. stocks make up over a third of a global market. I actually just recorded a podcast. It turned out way too long. So for those of you watching us, listening, like this is airing on December 31st. So Happy New Year, everybody. But if you want an episode that was maybe a little too long of me talking, it was like 17 minutes long. It's episode 233, and it's looking at a Goldman Sachs paper on the market portfolio and how it's evolved over time. And I sat there thinking, okay, you know, the S&P 500 is just such a small piece and it is simple, but it's not easy. So I always tell this gentleman, yes, you know, if you invested in the S&P 500, not just the last 20 years, but in the 30 plus years they've been clients, you know, there was a 12-year period in there where the S&P 500 lost to cash. And before that, there was like a 15-year period where that was true. And then I think that was like leading up to 1982. And then there was some period from, I'm going to get it wrong, but somewhere between the 50s and 60s where you had like a 17-year period where the S&P 500 trailed cash. And so Yes, I think the point, I'm riffing now, not, this is where a book could get too long because you're going to do the short hit essay thing. But it's something I'm really leaning into that. It's simple, but it's not easy. Your behavior is important. You need to know what else is out there. And, I think there are things these days that act as distractors. I personally don't feel like international stocks is a distraction, but Warren Buffett once said that they were, and Jack Bogle once said that they were. And I hate that they said that because I think they're wrong. And most people do. I mean, I think you agree that they're wrong. Is that fair?
Well, I would never say Warren Buffett or Jack Bogle are wrong, but I think as an everyday investor, you would be prudent to be diversified across the entire global equity market. So, because I'm going to bet on human progress across the entire globe more than I am in any one country.
Well, and what's so interesting, though, about what the market portfolio is, I'm just going to read off some stats instead of it being a 17-minute podcast by myself. So 86% of the market portfolio is still public stocks and bonds. But for as much airwaves as things like gold, private markets, crypto make up, looking across the globe, gold makes up 6% of the market portfolio. Private markets makes up only 5% and crypto 1%. Now, if you think about how much news and shiny object nature get put in front of people, and that if we're trying to start with the market portfolio, and when I say, hey, own the market portfolio, I'm usually just talking, I'm either talking about a total stock market index, maybe a core bond fund. Sometimes I'm offhand referencing it as the S&P 500. Reading your writing, I get the sense that that's sort of what you mean too. Is that fair?
I would say I use the phrase market-like portfolio on a regular basis.
Same.
When I quote market data, I tend to quote S&P just because it's by far the most accessible piece of information. But the same truths hold true on a total global market equity portfolio.
As I'm listening to you talk and I'm thinking about my own book, are there any points that you are going to try to make in the book where you're like, boy, I hope this doesn't happen in the market until my book comes out? So I can give you an example of mine. For example, like I have a chapter all in the history of markets, and I go into bubbles, and I actually separate it into like speculative bubbles and routine losses. And I clarify routine losses are the 10, the 20, even the 30% drops, just part of investing. But there are lots of parallels when you study the historical bubbles between things we've seen. And it does make you wonder, and I'm not trying to call bubble, but it would be really nice if AI doesn't blow up in our face before my book comes out. Not because I call a bubble, but I feel like there's a really nice parallel and a learning moment. But anything for you where you're hoping that something specific doesn't come out in the market, or is it too timeless to matter?
I would like to think it's too timeless to matter in the sense that, as an example, let's just say that this is a bubble, that there is a correction. Or let's just say that there's a bear market.
A correction doesn't matter, but like full out like deflating of an asset class. I don't know how, bubble, I like the asinus definition of like, you can't realistically model any possible future outcome to justify the price. The problem is you never really know what that is in advance. So, it's tricky.
I think Howard Marks says trees don't go to the sky. You could say that I think he was referencing Nifty 50 back in the day, whether you're talking about tech stocks in the late 90s, real estate in the mid 2000s, AI today. The point still is the same, which is if you own a diversified equity market portfolio, you are still fine. And so whether this is a bubble or whether this isn't a bubble, dollar cost averaging, if you're an accumulator, you should hope that the market does fall, because it's going to give you an opportunity to buy at lower prices. That should be very, whether I think Buffett again says, if we're talking about socks or stocks, I like to buy quality merchandise at low prices. It's the same thing. So if you're an accumulator, you should want stock prices to fall. Thinking that you just want them to rise without ever stopping would be foolish. And if you're on the other side, let's just say that you're in retirement, what you should do is create the conditions for patience to exist. So the way in which you create conditions for patience to exist is to create a sliver of your portfolio, sliver being, dependent on your personal financial situation, that isn't market dependent, that isn't exposed to the ebbs and flows of the market. So I know this isn't where we were going with this, but no, there's nothing really in my book that I think is overly dependent on anything that's happening in the market. I hope it's a book that I can publish, and then the only updating I do from then on is just where the market's at and what my multiplication factors are over time. Like, I would like to think that everything I publish is going to be completely and utterly timeless for the most part.
I've generally had that goal ever since I got to Plan Corp, because before I was at Plan Corp, I wrote something weekly that was very timely and always like closed out with something timeless to be like, hey, I mean, this is what's going on, but none of this is going to matter in 10 years. And I like that you mentioned, for people who are maybe on the other side of the accumulation, if they're in decumulation or nearly there, downturn doesn't have to be a big scary thing. If you're 100% stocks, hopefully you're 100% stocks because your liquidity needs are so small relative to the size of your portfolio that what you're effectively saying is a 20 or 30% downturn or a 40 or a 50 that's temporary it's not going to change your life. You, I think, like me, so I'll just say, like, I'm 100% stocks. I'm 40. Stocks. I'm 41. I'll turn 41 in 17 days. At the time of this recording, I will be 41, so I'll only be a year behind you. With the range of outcomes for 30-year stock returns is very narrow. And it hovers, you mentioned Siegel and Schwartz, they show you that the real return, the after inflation return, hovers around 7% across all sorts of environments for over 200 years worth of data. And they carve it up in 3 different segments too, that sort of says, like, look, yes, the world has changed, the economies have changed, but still look at how consistent this is within the different segments as well as the whole time period. I'm not against bonds, but at this stage, there's really no need. I'm not retiring anytime soon. The money I invest, I can't fathom a reason I would touch it. I even sometimes honestly struggle holding on to cash a little bit. I'll build up a cash reserve and then I find a good reason to use it. Tell me, I mean, I think you're kind of in the same camp of stocks for life. All stocks is a great thing. I know Nick Murray's that way, so that's part of it, but talk a little bit about that. If
you have no liquidity needs, I don't know a reason to hold any other asset class. I mean, I don't have any vested interest in what anybody does at this point, but I am 100% equities in my own portfolio. And there's a lot of people who will say, oh, well, that's foolish or what have you. And it's like, but why is it foolish? Like, imagine, let's change the subject. This is another thing I'm putting in my book, but let's change the subject. Let's just say you're going to a horse race. You're going to watch the horses run. You walk up to the ticket counter to place your bet, and you get 3 pieces of information. One is, for this first race, 3 pieces of information are there are only 2 horses in the race. One has an average speed of 2 miles per hour. One has an average speed of 7 miles per hour. Which horse are you going to bet on? Okay. The answer is pretty obvious. Now let's just say that you're going to make this bet for 50 races in a row, but you only get to bet on 1 horse. Which horse are you going to bet on? And it was as obvious it was in the first race. It's absurdly obvious in the second, because you're betting on this horse over 50 years, or let's just say multiple decades. But in the world of investing, people bet on the slower horse all the time. And I don't understand why. It's because they want to avoid temporary volatility. All volatility is temporary, historically speaking. Obviously, the future is unknown, but people have been betting against the future forever. And yet here we are, richer, wealthier, safer. I don't know about happier, but in most facets of life, we are far beyond what people expected in the past. And so to expect that the future is going to look drastically different from what we've experienced just seems kind of silly. But even if you don't believe that, logic alone should lead you toward equities. Because, like, why would anybody buy a company if they can lend to a company and earn better returns? It doesn't make sense. So either the return of bonds will fall to a point at which ownership is more valuable, or ownership is more valuable. So either way, you get to the same place, just from a pure logic standpoint. I mean, there's a whole, we could dive deep into that rabbit hole. I don't think it's worth it. But the point is just equities over any long period of time, there's never been a negative 20-year return. And oh, by the way, bad years for returns are great years for investing. So, even if you have some bad years ahead, most people's feeling is, well, I should take some risk off the table, or I should, maybe we should reallocate. Even if the future were that clear, the right answer would be, okay, well, just be prepared to buy when the time comes. And so, I don't know, that's a very disjointed thought, but
No, I thought that was pretty well put together. And I love the horse race. I kept thinking that somewhere you're going to throw in that one of the horses jumps over the fence and runs away, so you lose all the races.
Well, I was going to say is that in my book, I say that in the horse that runs 7 miles per hour on average sometimes runs away.
Yeah, right. And I think that's a classic, like gambling, sports. So sports is always an easy analogy for investing. And there's a segment of the population that gets alienated by that fact because they don't like sports. Gambling is even better because investing is such a probabilistic endeavor. I love gambling as an analogy, as a parallel. But like in a casino, it's fixed odds. And so sometimes I'll start explaining things like roulette is or blackjack or craps is different than horse betting, where, yes, the horse could sit down and take a nap, or it could jump over the fence and run away. And that's what investing is. It is not fixed odds. Mm-hmm. And what you and I are talking about, like in terms of the compelling case for not owning bonds. And again, I think there's a point where if you have liquidity needs in the next, I'm just going to randomly say 5 years, but I might even actually believe if I thought more about it, 3 years, you maybe don't want those in stocks if a major decline in stocks would hinder your ability to live the life you want to live, particularly in those next 3 years. And so does that mean you ought to have something outside of the portfolio? Or, there's a lot of people who believe in doing bond ladders for near-term liabilities. I have mixed feelings about that, especially because there's been so many innovations in like the ultra short bond space. I think do-it-yourself investors, you are messing up bonds. I'm sorry. Like that's the thing I think I feel strongest about in my audience, whether you're watching us on YouTube, on Cheddar, listening to the podcast. I think that that's where people mess stuff up. But I also think where people mess stuff up more holistically across the investing universe, the retail investing universe, and I'm going to say retail to include people who have an advisor, is that if you're worried about downside risk, and so you put your money into a 60-40 portfolio, you're still going to feel bad when the market's down 40%. You may not have lost as much money, but I've now coached people through enough large downturns. And this was most prevalent for me, and you were working at the same time. Like the financial crisis, the people who were in a 60-40 portfolio were still panicking.
They were still down 35.
And it didn't even matter. It was that the whole world was going to end. That was the narrative. It wasn't, It's never, and this is a key point in the book. You're welcome to use it if you'd like to, because I hope mine comes out. I hope I finish first. But like people, it's not the volatility, the numbers they have a problem with. It's the narrative. They're afraid of the narrative, and the narrative is always different. It's always scary. But I'm with you. I think in general, the more comfortable you get with the data, it's hard to invest in bonds, given how close I am to the stock data. My concern always when I'm advising others is to go to 100% stocks. There is like this more objective, measurable ability to take risk that has to do with these liquidity needs and the time horizon and maybe some of your human capital. The willingness, even though I do feel that a 60-40, people are still going to be panicked, I guess I still lean towards worrying they'd be more like, if you're going to sell at the worst time in a 100% stock moment, that is a lot different than selling at the worst time in a 60-40 portfolio. And I don't know, I'm kind of talking off the cuff. This comes with the lack of format of our show today. Any thoughts on that?
Yeah, well, to your point, most people's bad investing results, regardless of the portfolio in which they own, whether it's 60-40 or all equities, is really a crisis of expectations. For instance,
I like that.
If for right now, we could say, okay, right now we know the market's going to decline for the next 18 months and it's going to decline 30%. You would probably, let's just say that you just stuck with your portfolio just as it is, whether it's 60-40 or 100% equities, it's irrelevant to this question. If you knew that it would do X for Y amount of time, you would probably just by default be immensely more patient. What makes decline so difficult to endure is I call it the anxiety of uncertainty. You don't know how far and you don't know how long. But historically, we can look back and say, okay, well, we expect to see this level of decline, like a 5% decline happens 3 times a year. A 20% decline happens every 4 years. A 50% decline happens every generation. So you know that these things are coming. Or we don't know they're coming. We should expect them to come. When they show up is unknowable. There was nobody expecting an 18% return in the market this year. Nobody. And so if you got out in preparation of this quote unquote soon coming decline, you'd have missed out on a significant amount of money. Let's say if you have $1 million, you gave up 170,000 today. And if you are a market-like portfolio, more than that, because international has outperformed the S&P this year. And so it's just the idea that you think you're going to know when this is going to happen and how long it's going to go and how deep it's going to go. You just can't. And oh, by the way, even if you did know those things, or if you knew one was coming, but you didn't know how deep it was going, how do you know when to get back in? I forget who said this. I think this one is, I don't know. It doesn't matter. When it comes times to buy, you won't want to.
Yeah.
So like nobody was wanting to buy late 2008, early 2009. And yet that is exactly what people should have been doing. And so I think coming back to your question, what's really important is just setting expectations that, look, these are a natural part of the investing process. It doesn't matter what type of portfolio you're holding. But if you want to be more conservative, you have to understand that you're not taking less risk. You're taking a different risk. Because people who say, let's just say somebody wants to own 100% bonds because, oh, quote unquote, it's safer. Never mind the fact that we're in the 63rd straight month of drawdowns of bonds. But let's set that fact aside for a minute. If you owned 100% bonds, you're not taking no risk. You're taking a different type of risk. You're introducing purchasing power risk because now you're giving up that 7% real return for a 2% real return. If you get 2% real return, there's no guarantees there.
Yeah, some decades
for a variety of reasons. But the point is just that you're taking a risk. You're just taking a different type of risk. And that's something that too many investors overlook is everyone is taking risk. There's no such thing as no risk. It's just, when do you want it?
Yeah, I really like that. And I also really like just the idea or the reminder that expectations and reality, how close they are, how far away they are, can dictate a lot of behaviors. It can dictate a lot of happiness. I tend to feel like regret. I've honed in more on regret than anything as being the primary cause of investment mistakes. I realize that you can technically draw a line to a lot of things, but for me, that seems to be the one that I see most frequently in people who are behaving badly in their portfolios. And when expectations and reality are far apart, you set yourself up for regret. And you mentioned something that, and I'm going to do like a Morgan Housel quote. We're just going to quote people all day here, and I'm going to mess up the quote too. But like volatility in the moment seems like a risk, but in hindsight, it always seems like an opportunity. And so you said it, the 10%, the 20%, you gave the dates, the 30, 40, 50. You have to expect that markets are going to experience downturns with a similar magnitude and frequency as they have in the past. And if you know that, and you really not just know it, you believe it like that is your religion, that is going to church belief, you're going to be fine. And that's when I think, as mentioning earlier, I hesitate on a 100% portfolio for people I don't know well, because ability I can measure, it's pretty objective. Willingness is sort of where you get into that more religious fervor on how much do you believe, because the data is there. The data is strong. Doesn't mean the data couldn't change. Nothing is permanent in this world, but you do get a big enough data set and you can make a pretty good inference from it. Let me ask you this on reality versus expectations. I had made a little note to circle back to private markets, to crypto, to gold. Maybe it's within the context of reality versus expectations, but pick your poison. Pick one of those places and just hit me with your thoughts.
Well, I could do all of them very simply.
I have no doubt.
So private equity, I tend to look at it this way. Imagine you're going to a buffet and you go to the buffet, but the line is the queue, if you will, is organized by net worth. The everyday investor is at the back of that line. So you're going to get what's left over once all the big money has passed over all the good deals. Private equity funds inside your 401k are not going to get access to the same opportunities that Sequoia Capital's getting opportunities to buy. You're just not. And so the idea that private equity inside of mainstream ETFs or publicly available ETFs or mutual funds, I just don't see as a real possibility. Just the logic, again, doesn't pass. As far as gold and crypto, I look at them very similarly in the sense that they don't produce anything. So I don't believe in investing any money into anything that is purely speculative. And there's an abundance of people mind you, all who have a vested interest in me believing something different, there's an abundance of people who will say, oh, well, you can fundamentally evaluate Bitcoin, or you can fundamentally evaluate gold. You cannot. There's literally no possible way. That's not to say the returns won't be great. I'm not saying they won't or will be. What I'm saying is they're not evaluatable. They both depend, and just the same as any non-income producing asset, depends on broader adoption for the price to go up. It's literally the only way for the price to rise. So if Bitcoin wants to go up, more people have to buy it. Otherwise, it would stay exactly, if the same buyers that owned it today just owned it from now till forever, no one ever changed hands again, Bitcoin price would stay exactly where it is now. Equities are different. Equities are, if I own a single member LLC that has rising revenues and profits, I don't have not a single share of my company would have to change hands for the value of my company to rise. And so equities are decidedly different than, say, crypto or gold. Again, it's not to say that, there's a lot of people who say, oh, gold has a place in a portfolio, crypto has a place in a portfolio. If you want to own a market-like portfolio, it's like, yeah, but I just can't get there rationally simply because there's no way to evaluate it. Do I think that broader adoption will continue in crypto? Probably, but I don't have any reason to believe that. I mean, I'm still guessing, just like everybody else is guessing. You could say, oh, well, new ETFs are popping up and that's driving broader adoption. If that's true, then it's proving my point, not anything else. And so just at a very basic level, that's kind of my thoughts on kind of all three of those topics.
Yeah, I'm firmly out on gold and crypto.
Yeah.
Full stop. I often facilitate people who still invest in them despite me explaining why I wouldn't do it. They are based on stories largely, and there are some stories that you can tell me and I'd say, okay. Like at the end of the day, we're advising clients, it's their money. If they want to go buy an expensive piece of art or collector's baseball cards or even just individual stocks, because I'm out on individual stocks too. I don't believe in buying individual stocks. And so, if you want to go buy any form of crypto or you want to go buy gold, I sort of put it in that bucket, because when you're buying an individual stock, even though it's a productive asset, you're actually buying a story. You are buying a story. And I think there are some stories with crypto where I will really fight people. I'll just say that's just not accurate. That's just not a thing.
Yeah.
There are other stories where, much like you said, we can't know what the future holds. And if you want to do that, I don't agree. It's not a story I would buy into, but I'm a little bit like more, okay, like here's how we would facilitate that. Yeah. With gold, I'm just waiting for Elon Musk to land on a meteor, much like Bruce Willis and Ben Affleck, and but instead of saving the planet, they're just going to drill all the gold out and bring it back and ruin its value. But I kid, but I also maybe. With the private stuff, it's pretty nuanced. I've done enough episodes on that people can go, let me ask you this. So I will share my own framework, and then I'd love to hear how you would think about it. But if I were to win the lottery and tomorrow after-tax $100 million gets deposited into my bank account, I bet that I will make some private investments. I think the reason I will make them is not because of portfolio theory or asset pricing theory. I'll probably do it because it gives me something to do. It's interesting. The type of investments, if I had that type of money, I would love to put it into something where perhaps I have some expertise or perhaps I can be a little more hands-on, but it wouldn't really have anything to do with asset allocation. And so I think what I like to tell people is that I'm not necessarily against private markets. For those where we, again, facilitate private market investments and perform due diligence, I don't view it as an exercise of asset allocation. We don't make those investments for people with less than $20 million. And so there's people who are legitimately overweight liquidity, where once you understand what it is and the why, I'm sort of like, okay, like as long as we all have, again, good expectations, because with private markets, if you're not in the top quartile of managers, your expectation, your reality is not going to be very happy.
Yeah.
And so I think that's where I find it nuanced. This idea that they're coming to our 401ks, which they are. Vanguard, I am happy to report, is not going to just drop them into their target date funds. If they go that route, they're going to launch a new set of target date funds that just happens to have it in it. Makes me feel a little bit better about the state of the world that we're in. But yeah, in general, like I try to think of like, if I had so much money, more money than I would know what to do with, yeah, I'd probably own private investments, but it's not really for any of the reasons that you hear in the media, that you hear salespeople and advisors say. And oh, by the way, all those things that you hear in a sales pitch, they're all facts. All of them. They're all factual. They're just not relevant. And that's where I think the challenge comes in. So let me pitch it to you. You get $100 million in your bank account, no taxes owed. Are you going to own some private investments?
I'm so
beyond the business that you currently own and run?
I'm so glad you pitched that question back to me, because I was going to challenge you on it, in the sense of, it's one thing if you have some level of expertise to offer some individual company. So in that case, it's private equity, but you're not leaning on somebody else to provide that expertise. However, what I would tell you is, while I would love to say, yes, I would not do this. I've never had somebody drop $100 million on me, so I can't say that without question, but 99% I wouldn't. And here's why. If you look at the rotation in the Fortune 400 list or whatever, all these multi-billionaires, none of them would have landed there without taking some outsized bets with their money. But on the other end of the spectrum, there would be almost zero turnover if once they got there, they just bought index funds. And so it's kind of like, if somebody handed me $100 million, it's like, okay, well, you have generational wealth. And the only thing you have to do to keep it is to follow the same fundamental, plain vanilla, very boring investment principles. I like to think, given everything that I know and have learned over the years, that I would pick that plain vanilla, boring index portfolio and move on, because there's no such thing as guarantees. Even as a non-practicing advisor at this point, I still will willingly admit there's no such thing as guarantees in the markets. But I would give myself the best possible probability of continuing to expand that wealth by going with that plain vanilla, boring index fund portfolio. So I kind of go back to that idea of the Fortune 400, and it's like, you don't get there doing that. You don't get there with the plain vanilla, but you stay there.
Yeah, if you have 100 million, you don't need to at that point. I mean, I don't know how much more money you need if you have 100 million in the bank, but
no, exactly. And none of us, if you're listening to this podcast, we're probably not going to end up on the Fortune 400. So we don't really need to take the bets that they've taken to get there. You can still become fabulously wealthy with the plain vanilla, very boring index portfolios. But the way that you stay wealthy once you get there, I'm very sure of that answer.
Yep. The getting wealthy and staying wealthy are different skill sets, very prevalent. And yeah, I think when I think of it, it's interesting that you frame it that way. Like, even though I say I would do it, it'd be more like hobby than, like I said, it wouldn't have anything to do with asset allocation or asset pricing theory or portfolio theory. But if my friends needed an investment, I mean, it's almost like charity, but it's more interesting. It's like an expensive hobby. Let me ask you this. If you win $100 million, what's the first thing you're going to buy? This is the hard-hitting questions we have here on the long-term investor.
These are big questions, big questions. I don't know. Probably a different car. I don't know. I'm grateful to say I'm absurdly blessed. I'm grateful to say I probably have. I literally just built the house I'm standing in right now.
Congrats.
I don't know that I would do a lot different, to be honest with you. Easy to say. Again, nobody's dropping $100 million. Peter, if you want to send it my way, I'll give you my wiring instructions.
I'll make up a crypto coin and say it's worth that. What's funny is, so again, this is a very unformatted conversation. And I have always told people, if I win the lottery, the first thing I would buy is a pickup truck, because I've always kind of wanted one, but it's just not practical, and I don't really need it, and I don't need a second car.
Is there anything, I would challenge that. Is there anything more practical than a pickup truck?
Well, let me tell you, is this morning on the way to school with the kids, my 8-year-old is a big, would you rather guy. And he asks you all these random would you rathers when you're in the car. And the longer the drive, the more you get.
I love it.
But it was like, would you rather live in a car for 9 days or live in a place called Spider World? So this one was a little poorly framed, but we started talking a lot about living in the cars. And I was talking, you know, those Sprinter vans that are like RVs, but they have like a bed.
I would totally do that. Oh yeah, I would do that.
I've decided that is actually what I would buy. Yeah.
So I'm totally
I looked at, they're
$150,000,
and like that's just like a starter one. So I've now amended it from like decked out F-150 to like one of these Sprinter vans that you can live in. And I'm not sure why, but I think I would do that. That sounds fun.
Right. Have them make 2 when you do it.
I will. We'll get matching. We'll have our initials on our license plates. You know, I had so many places we could have gone today because, again, new format, just chatting with you in a public setting as opposed to just while we're on a walk, although there's snow outside. So the walk would have been bad today. But Ashby, I'm going to call it here. This is really, really great. I will be sure to link to your profile, social media stuff in the show notes at thelongterminvestor.com. But appreciate you sharing some time when the book comes out. Obviously, you'll have to come back to the show.
It'd be great. I love these conversations. I appreciate you having me.
All right. Talk to you soon.